Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. Today, I've been working very hard on this one. This is a company analysis. So I'm going to give you my take on Viper Energy, not Viper Energy Partners anymore. They are a corporation, a royalty co, which you know that I love. Today, we're going to take a deep dive. This is going to be publicly available and in the ROI Club. So if you like this type of analysis, you can click on the link and check it out for free. It is a holding of mine in my personal and publicly available portfolio on eToro. Disclaimer, housekeeping, nothing I say is advice. This is just me sharing my opinions with the world, and sometimes I'm crazy, so you have been warned. What I would advise you to do is to click the like and subscribe button because it helps with the algorithm and it encourages me to continue focusing on this kind of thing when I have many other businesses to attend. In any case, here we go, guys. So at least at time of creating this presentation, here's a one-page overview of the company. Okay, the company at a glance. All I really want to point out here would be the return on invested capital revert and return on equity numbers down here, along with the margin. So obviously gross margin 100%. That is wonderful, and that's because of the royalty business model that it operates. That's going to be important coming into, well, not coming into, we're into already an inflationary period, a stagflationary period, as I would argue. In any case, the balance sheet looks great on the company. That's all we really need to see here. Executive summary, pretty simple. Viber Energy, oil and gas royalty co. Okay, so they have leases which their major shareholder Diamondback. They do a lot of kind of back and forth with the leasing with those guys, and the interests are in the Permian Basin. Okay. They calculate their royalty acres differently to others. So if you're looking at a net basis, 34,500 net royalty acres all across the Permian, 68 rigs operating at time of studying. The other thing I want to point out in terms of this particular company is it was a limited partnership, which is good for income investors, generally speaking, in one way, because it basically, in many cases, if not officially mandated, it's highly encouraged for them to distribute all of their cash flows. They converted to a corporation. Why did they do that? Well, they did that for a few reasons. It gives them the opportunity to buy back stock. And I think the biggest reason for that was to enable them to attract more of an institutional base and to be included in indexes. So they're only at, I think, 2% institutional ownership, and that's significantly improved since then. This line is from a company presentation, but I think it sums it up very well. So Viper's mineral and royalty interests provide significant exposure to high margin, largely undeveloped assets with zero capital requirements to support its free cash flow profile. And so if you've seen my work recently, you know I'm obsessed with these types of companies, these asset light inflation beneficiaries, as they've been called by the guys over at Horizon Kinetics. Wonderful business model. The operator bears all the capital burden, and you get the upside of both the cash flows and future potential development upside. So if they can develop more of their acreage, which is untapped, you get access to all of that without any further capex, which is something I think people forget about. Here's a basic chart from the quarterly presentation. So if we take a look here, what's important? So we can get an estimate as to their production. So management are guiding 46 to 48 million barrels a day equivalent oil. And at a WTI price of $80, they're expecting to be able to distribute 3.5, so $3.50 per share in distribution. So of their free cash flow, that amount would roughly be distributed as a dividend. And at the time of compilation, at least, that represents a 9% annualized yield. So that's a very attractive yield, in my opinion. It's not using crazy assumptions. It is going to benefit really from inflation, which is what I think is the biggest threat. And it's quite an attractive dividend that will give you a real yield and pay you to wait. The acreage. So we've got a royalty company with interests in a business that is depleting every year because it's a natural resource business. So we need to take that into account. no good buying this thing if it's going to run out of production next year, of course. So this is always going to be a guess, but how much does this company have in the way of reserves? According to what I've seen, at least, they have proved reserves of, let's call it 149 million barrels a day equivalent. It's probably gone up since this was compiled. But the point is, they have this is P1, so that's been proved, and they've got 1,000, or they are estimated that they've got 1,000 gross wells available in undeveloped acreage. Okay, how much they can, how productive that untapped acreage is always a guess. So converting this to barrels of oil and per day, let's take what we have been told approved reserves and divide it by the days, and then divide that obviously by current production expectations. So 48,000 barrels a day. I think I said million before, so ignore me. I saw the M and I got confused. I meant to say thousand. The reserve life divided by the annual production, assuming that that production will stay flat. Okay, we're just trying to get a rough ballpark figure. So we've got 10, call it 11 years worth of proven production out there in these fields that they are already operating. And then we've got potentially another 1,000 undeveloped wells. Okay. So back of the envelope, I look at this thing and I say, okay, well, if you've got proven developed producing wells worth about 11 years of production, and you're trading at 90% free cash flow yield, at least to the market cap, adding in the debt will change that figure slightly. You're buying the company, at least at market price, for 5 years worth of production, and you're getting roughly 6 years for free on that production, as well as a call option on all the undeveloped interests. And that's fairly simple. Here we've got the Q1 results. Okay, so we're looking at base dividend and variable dividend. So they'll do this base variable thing, and sometimes it's a bit annoying actually, but in any case, you're looking at this return of capital on a per share basis on the right, total on the left, and this is for 1 quarter. So they're paying out 75% of their free cash flow. And remember, they have no further capex to develop. So it's not like an oil producer where you have to, if you're assessing the sustainability of the dividend yield, you need to work out, well, how much are they actually reinvesting for future years' production? These guys get access to Diamondback and whoever the other operators are. They get access to their production on their acreage through their royalties. Okay, so once that's agreement's been made, it's made, and that's it. So they can use the rest of the free cash flow for potentially acquiring more royalty interests, adding out more special dividends if they really wanted to. But hopefully, in my opinion, when their price starts to drop for whatever reason in market fluctuations, I would love them to use that as a buyback mechanism. Getting into the more of the numbers, I've drawn up a sensitivity table here. The BOE price is adjusting for gas and natural gas liquids. Okay, so that's also a part of what they sell, obviously, as the guys operating on their leases. On the left, that's the barrel of oil equivalent realized, so what they actually are getting. And this is what they were able to realize as of the last quarter. And so what I've done here is to make a bit of an estimate as to the sensitivity between what prices they can sell at and how much distributable cash flow that would mean for the company using historic margins. And then, of course, taking 75% of that as the amount that will be paid back to shareholders, and keeping it conservatively in that vein. So I'm not giving them any credit for cash for buybacks or anything like that. I'm just saying purely a dividend yield. What might that look like, sensitized to different sales prices? So you can see here, if they were to continue selling at their current realized prices, at today's stock price, you're looking at roughly a distribution yield of 10.5%. I guess that's pretty good. And if we start to get into this environment that a lot of people are expecting, particularly when it comes to natural gas prices, which seem absurdly cheap, this company has a decent amount of upside to that price, but it doesn't have the downside because it's not responsible for the operating expenses. Speaking of operations, in terms of the access to increased production that this company has, here's a look at the production that the company enjoys, or access to the production that the company enjoys over the last 10 years or so. And then I've used a compounded annual growth rate. So they've been able to grow the production on a per share basis as a royalty company. So they're not actually doing the drilling and the operating expenses themselves, but they've been able to grow their access to those reserves at a rate of 23.5% compounded annually, which I thought was quite impressive. In addition to which, if you look at the revenues, that tracks at 28%, and the distributable cash I've actually calculated as 23.4% on an annualized basis, going back over almost a decade or so. So if you take the projections to 2026 and you go back a decade from there, that's what I've done, and I've put that into a formula here. All I wanted really to point out was, as impressive as those growth numbers are, there's a very low delta between the two, meaning that they get to keep a hell of a lot of their revenue. Whereas I think in a lot of cases, companies that have to quote unquote buy their own growth on the top line, on the revenue, you don't always get net income or free cash flow growing at the same rate. So here I've taken a base case, okay, and I've assumed that they could continue to grow at that historic rate of 28.5% on the free cash flow yield. And you can see what that looks like in another table. Okay, that's all I've done. Moving into the next table for you guys. I know I'm throwing a lot of numbers out here. What you've got here is you've got that base case. I'm assuming just 49 barrel of oil equivalent realized, and I'm extrapolating that out over 10 years, assuming that they can grow that dividend at the historic rate. And remember, of course, if they get a higher commodity price environment, their free cash flow will commensurately increase. Then I've discounted that back to today's value, just using a 10% discount rate. So here's this year, and that looks quite reasonable in terms of what you would pay for the end of this year's dividend. If we get to the end of the decade, let's say, and you'll be paid what I think is a reasonable estimation of all these dividends over on the right here is their present value. On the left would be the actual nominal value. You're getting a real return, okay, a real value today of $77.20. So you're looking to make your money back plus another 100% roughly in this environment, in my opinion, fairly safely through dividend streams alone. So 10 years, will this company be in business or out of business in 10 years? I personally think they're going to be in business for a lot longer than 10 years. Obviously, the further out we go, the harder it's going to get to calculate. So we don't want to get ahead of ourselves. I'm going to say, hang on a sec. What if this happens? And obviously, you can make your own assumptions and do the same exercise. What scenarios out there might unfold into the future? So what happens if the company grows at this rate for 10 years and then they just grow at a rate roughly equivalent to the population? So let's just call that a perpetuity, or not a perpetuity rate, because I'm going to cap it at 2050. Okay, so I'm assuming over 10 years, the company's going to grow at 28.5%. Then after that, between years, so 11 to 50, and between 2033 up to 2050, I should say, then they're going to grow in those years at 3%. And then after that, I'm giving them zero value. I'm going to assume that they just shut up shop, close down the company, which again, I don't think is going to happen. But this is a what if page. So the total valuation, if you were to follow those assumptions, which I've listed here for those of you who want to play along at home and whip out the Excel spreadsheet, those are the assumptions. I value the dividend stream using discount rate of 10, $276 today. Okay, so if we're patient, and that is multiple returns on capital from the dividend stream alone, and remember, it's not paying out 100% of its free cash flow. I think if you're patient, you can do very, very well with this thing over time. And when you start to think about long-term investments, the number one threat that you have is inflation. And yet this company is going to benefit from inflation because by definition, almost, the master commodity oil will be the starting point of inflation seeping through the system. So a higher oil price will mean higher royalties for this particular company. In the down years, this company does not have the downside of having to pay operating expenses And so it can endure a few down years and maybe you have a very low dividend in those years. But over time, if you believe what I've done here is reasonable, it could give you a reasonable estimation as to the cash flows that you could receive if you were to buy the company today. So that gives a bit of a visual. You'll see, I'm assuming their fantastic performance that they've historically been able to deploy in a lower price environment continues for an inflationary decade. And then I'm saying things start to cool off a little bit to 2050. Obviously, if you think the company's going to continue to make money after that, then everything else is, gravy on top. So there's the presentation. My thesis, that's all it is just my ideas, guys. Don't get carried away. I'm long the stock and I want to build it to a heavy weighting if I could. I want to get to at least 5, if not 7.5%. It's a quality company, it's very predictable. It is an inflation beneficiary, given that it's asset light and has royalty upside to commodity price inflation. It's growing its asset value, as you saw through the production per share or the production over time, and you're getting paid to wait with little risk. So if nothing really happens with the stock price for a few years or so, it really doesn't matter to you. You're just sitting there taking very, very high yields, and obviously you could redeploy that capital however you see fit. So hope you enjoyed that. If you did, like, subscribe, and check out the Substack for free below. Put your comments in the comments section, and I look forward to catching up with you in another video shortly. Take care, guys.